Hello and welcome to the Better Dwelling Channel. My name is William TRAN and joining me today is Ron Butler. You might know him on Twitter as Ron Mortgage Guy. How's it going, Ron?
Real good, real good,
Okay, let's
really good.
go right into these questions. What is happening in the market right now? Are we in a recession? And what are some of the challenges Canadians will face into the new year?
Well, it's not a recession in the way that we would traditionally think about a recession. There is no broad-based unemployment. The economy is probably running at about zero, which is not a recession. However, what we're experiencing right now is a pretty severe, maybe like a 33-year disruption in the Canadian real estate business. We're starting to look at, for instance, it would appear that the December numbers that will roll off in Ontario, TREB, in terms of house sales, will fall to the incredibly low point of the height of COVID, when people couldn't even go out and look at houses. So, we're talking about catastrophic levels of volume reduction in terms of house sales. And let's face it, there doesn't appear to be any reasons on the horizon for that to immediately improve.
What do you think the BOC will do? Will we see higher rates in 2023?
Yeah, I think we'll see another 25 beeps increase. I don't think they're going to run 50s or 75s right now. I think we will see at the end of January another 25 basis point increase. We might see an additional 25 basis points in March. But I think that the severe increases are drawing to an end. I think that there is going to be pretty obvious demand destruction by March, which, even though inflation may not slow abruptly, we had very tiny reductions of inflation and virtually a tiny rise in core inflation last time. But I think the obvious effect on certain parts of the economy are going to be too obvious for the Bank of Canada to continue aggressive rate hikes. And in all likelihood, inflation will at least start to subside in a gradual way. There's really no doubt, though, that rates will not go down. Like, prime rate will not go down probably for the entirety of 2023. Now, could something happen that makes that necessary? Could there be like a roaring recession by the summer, like a severe gut-wrenching recession by the summer? Possibly. I don't necessarily think so, but if we just look at things as they are today, the likelihood of prime rate from the Bank of Canada going down in 2023 is slim and none, which means all of these high rates continue, and you can't sustain the kind of prices we have in the Lower Mainland and the GTA with these kind of rates. I mean, with rates that are mainly in the fives, prices have to come down more.
Yeah. How will Canadians afford housing into the new year? Any strategies or suggestions from your end on what first-time home buyers, homeowners, or investors should look out for?
Well, I think that if we break it down, there's a group of people who are unaffected. There are people who have fixed rates that will not renew into 2024, 2025, and they're pretty damn good fixed rates. They are great rates, and those people are very much insulated and are sort of happy bystanders to what's going on right now. For people with variable rates, many triggers are being hit. This additional expected bump of 25 basis points will cause more triggers to be hit in the folks who have static payments. And there's already pressure building for them to pay more, coming from, depending on which bank they're with. There's obviously a group of people who have rates that go up every time prime goes up, and they are suffering right now. Those increases are very well documented. They are very real. We read about them on Twitter, YouTube, we hear about it, TikTok, we hear, in the real world of consumers, mortgage holders complaining about how bad it is. We hear about how bad it is for those who have seen constant increases in their variable rates, because some lenders' variable rates go up every single time. Every single time that prime rate is raised at the Bank of Canada, they see an almost instantaneous increase in their payment. And that certainly is also true of everyone who has a home equity line of credit, HELOC. For everyone who's had a HELOC, those payments are up, like the minimum payments up like 130%, 125, 130%. Like it's very meaningful for those people. So we're going to see that continue. We're also going to see in 2023 between 12 and 13% of all fixed rates mortgages renew. So they're going to come from an environment where they were paying a rate that started with a 2 or started at worst with a 3. And they're going to move, in most cases, they're going to move into a rate that has a 5 handle. And that's going to be shocking for those people. No question that those affordability issues are going to come to bear. This is all, except for those people who have these great fixed rates locked in for another 2 or 3 years, this is going to be nothing but a bad news story for Canadians with mortgages.
So I know you touched upon this a little bit, but what has been the reaction from the increases in mortgage payments for the people that are struggling? Do they need to start thinking about selling?
Well, for the people who are truly struggling, for people who can demonstrate real hardship to their bank lender, it's always best to ask for reamortization. Now, sometimes what does reamortization mean? That means that you've been had the mortgage for 5 years, 3 years, 6 years, 8 years, 10 years, however long you've had it, and you're experiencing this significant increase. Well, you may have gone from 30-year amortization, and you've paid it down for 8 years, you're now at 22. Ask to go back to 30. Approach your lender, see what's possible. It's very important that people reach out. And if there's anything that I could underline more than anything else, if you're in true hardship, you need to reach out to your lender. Don't keep it a secret. Don't think that it's something that you shouldn't talk to them about. You should. There's some situations where we've seen large credit unions in British Columbia and other credit unions in other parts of Canada. They've gone ahead and increased amortization from, say it was at 25 years, they pushed it all the way up to 25 or 40-year amortization to give their variable rate customers an ability to make the payment. So there is a bunch of facilities available. They're just not available for every mortgage holder in every situation with every lender, but they need to be explored. Like expanding amortization. If you're at 25 years now, can you go to 30? Can you go to 35? If you're at 20 years now, can you go back to 30? What can you do to try to alleviate these payments? Please, I tell everybody the same thing. Reach out to your lender, explain your situation. By the way, it's unlikely the lender is going to respond to somebody who just says, I hate paying more. I can do it, but I don't like it. So help me. The lenders typically need to feel that there is genuine hardship and that they may not have too much sympathy for people who have a lot of rental properties. I mean, that they may not. I mean, we're not sure about that yet. I mean, we're entering into unknown territory, but absolutely we know that amongst a group of lenders, people who have had CMHC insured mortgages, that is to say they've had low down payment, variable rate mortgages, those people, we've seen some of those people go right to 40-year amortization through the permission of the mortgage insurer. So there are some possibilities out there. They should be explored. That's the key. Go ahead and ask.
So what would you recommend right now? Would you recommend fixed or variable rate loans?
We're currently recommending short-term fixed. There's a couple of reasons. Firstly, we don't believe that these very high rates will sustain for eternity. The people who think that, mortgage rates are going to go to 8 or 9 or 13%, they're probably on the mushrooms or microdosing or something. I mean, that's not possible in the real estate world, the financialization we've created in Canada today and in the United States for that matter. Those kind of rates will not happen. I know a lot of people like to say, oh, you said that the prime rate could never get to 4.5%. You said it was impossible. Yeah, so definitely wrong. That was wrong. But we are starting to hit, if you listen to what Jerome Powell is saying, if you listen to what Tiff Macklin is saying, they're starting to believe they've hit the maximum that will not cause significant breakage in the economy. They're willing to go a little higher. Don't get me wrong. I'm not suggesting they won't go higher in rates. But the idea of 8, 9, 12% interest rates, mortgage rates in Canada, prime rate, with those kind of numbers, this isn't possible. This isn't manageable by either governments, which owe money, and some of that money is at prime. It's not possible for people who have mortgages. The most important thing to understand when anybody says, oh, these rates are still within historic norms, the important thing for those people who are saying that to get is that historically, people have never paid more than 3 times their income for a house or in a condo or anything else. They've never paid. If you look historically, it's somewhere between 2.5 and 3 times income is a historic standard house price. We're looking at 7s, 8s, 10s, 11 times income for some of these properties in the Lower Mainland, GTA, and other cities. This is big difference. This is a very important difference. It's something that a lot of us have talked about incessantly, and we're not always paid attention to. But this is critical. You can't have a 7, 8, 9 times income house and think that 5% interest is going to work long term. It's just not. It's just not sustainable. So will interest rates go back to 1.99 and 2.49? Probably not. But interest rates are unlikely to stay in the 5s or low 6s for a long period of time. It's not really manageable with these house prices, or house prices have to decline even more dramatically. House prices have to decline to 2013, 2012 levels, which again is major breakage in the Canadian economy. You can't have one thing without the other.
So one insight that we got from you is that older households aren't selling, but they're leveraging their property to buy a new home. Has that changed much over the past year?
Yeah, that's disappeared. There's no more leveraging to buy additional properties. The numbers don't make sense. The HELOC rates are too high. The mortgage rates are too high. The property prices are too high to buy rentals. And the mortgage math of buying an investment property or keeping your old property and buying a new property to live in, all of that math has gone sideways. It's just not manageable anymore. It just doesn't make any sense. So that segment of the marketplace has vanished.
What does the BOC need to do in order to keep inflation down? And what will happen if BOC stops raising rates?
Well, I think the BOC will probably stop raising rates. They'll probably stop raising rates within the next quarter. The effect is that these rates are very high. They're very high for people who have mortgages and HELOCs, and difficult to manage in some cases. So what you're going to see is a demand destruction effect. It may run a little more slowly than it has in the past for a bunch of reasons. That no era is exactly the same as the previous era, but we will definitely see an enormous slowdown. We're already observing it, like a cataclysmic slowdown in real estate sales. And that's going to trickle down into other areas of the economy. And the BOC will get the result. Their inflation will come down because demand will be destroyed for certain categories. And certainly right now, it looks like real estate's one of them.
So going to the pre-construction market, what's happening over there? Is it heavily investor dominated right now?
They're not selling. We've had a lot of we hear a lot from people in the construction world who are trying to do pre-sales of townhouses and single family detached homes, and it just ain't happening. I mean, there's stories of people coming out and putting deposits, but the majority of the people we know who are involved in new development are saying it is phenomenally slow. It's not getting taken up. Here's the key: these people have to adjust their pricing too. I mean, the people who build townhomes, semis, detached, and even condominiums, condominium apartment towers, they have some price adjustment to do. The mortgage math doesn't work for the people buying those new properties either. I mean, this is just math. So will there be projects shelved? Yes. Will there be a requirement to change some pricing of some of these construction projects? Probably, but that's hard because pricing in some cases is part of your lender covenants that you've promised the people who are giving you the construction financing that you will realize a certain price point. Not true for everybody. A lot of the really big, strong developers are very well financed. They're very rich. I mean, if you look at the top 5 developers in Ontario, these folks are richer than God, these folks. And they mainly are actual families. They're actual people. Some of them are publicly traded, but most of them aren't. They're actual people, and they're phenomenally rich from the last 15 years of endless price run up, where they've made just tons and tons of money. For smaller developers, for people who come new to it, they could experience some legitimate financial problems. But at the end of the day, we're not seeing pre-construction flying out the door like we saw for the last 15 years. Just aren't seeing it. And in all likelihood, it will grind down even slower in the new year, because those prices have really not adjusted. They have not come way off. They are not dropping 15, 20%, 30% new construction price offers. They're not down 30%, and people just can't afford them.
Do you think we need to see any sort of change in the stress test?
That's a good question. For this reason, if you look at the story behind the stress test, the story behind it was that the regulator, the Office of the Superintendent of Financial Institutions, in 2016 said, hey, the rates that we see today are phenomenally low, and we need to add protection to make sure that when renewals occur, that the consumer can handle it, the mortgage consumer can handle it. So we're going to introduce a stress test. At the time, it made a ton of sense. It particularly proved to be absolutely true through the incredible price run up of latter half of 2020 and all of 2021. Unbelievable price run up in that period of time in many regions of Canada, not just the GTA. Prices went way up in the Maritimes. They went up big. They went up all over the place. So the regulator was right. There should have been a stress test, and it was necessary and it was important. What we can think about right now is that these sort of rates that we're looking at, all in the 5s, they're being stress tested in like the 7.5 range, stress tested in the 7.5 range to qualify for a mortgage. If you start to think about where mortgage rates have been for the last 30 or 40 years, 5% rate's pretty normal throughout that full 40-year period. And certainly people could handle that. People then did handle that 5% rate. There is a real case you could be made that the danger of ultra low rates that required the stress test has passed. Now, I've also believed that the stress test is a drag on housing activity. And for the last little while, that's been an important feature. In other words, it's not just protection for consumers, it's also a drag on the whole housing process, house buying process. So to tell you the truth, I'm ambivalent. I recognize that the rates we have today are at such a point that there's probably not a particular need for a stress test, not at 7.5 anyway. By the same token, I feel that we need to get house prices down in Canada. And people who own houses or bought houses recently probably want to try to find a way to come to my house and burn it down with me in it. But for saying that, but I also think it's an important consideration. It would be great if house prices got back to 2012 levels. It would also be very, very damaging to people. But in the long run, getting this ratio of 7, 8, 9 times income to for purchase prices of homes, that needs to be looked at. There needs to be thought given, and ultimately we need to get that number down. We may never get back to 2.7. When I bought my first property in Ontario, it was at 2.7% of my income. That was the purchase price. That's a manageable number. 7, 8, 9 times family income is not a rational approach to house buying. So stress test, I'm ambivalent. Probably don't need it, but I'm happy with anything that might bring the price of houses down.
And going to that, will we continue to see sales and prices fall in the real estate market in 2023?
Absolutely. We will see extremely low rates of volume of home sales, particularly in the first half. It's really hard to predict what's going to happen once you get past 6 months. There's so many different things can happen in the world. Governments can decide to intervene, change mortgage rules. There's lots of things that could happen. But based on rates as they are today and buyer sentiment as it is today, the volume of home sales will continue at record lows in 2023, and prices will grind down. Probably throughout Canada, prices will grind down because these high interest rates, or relatively high interest rates compared with the past, compared with the last 15 years, they even affect people in Manitoba and Winnipeg. You know, it's high rates affect everyone across the country. So prices will grind down. They will particularly grind down in the high-priced areas such as the GTA and the Lower Mainland.
So if prices grind down, should home buyers take advantage of these lower prices, or should they just wait?
Once again, there'd be a group of realtors who, like to arrange for my death when I say this, but yeah, people should wait. I mean, it's like anything else. If you don't absolutely have to buy, and let's face it, sometimes people feel they must make a house transaction. I mean, there's marriage breakdown, death of the family, change of employment that really, and even some people who are saying, I just can't make these mortgage payments anymore because the rate's too high. They may simply be forced to do a house transaction. They have to do it. And there's people who might say, well, that's a house in a particular neighborhood, right down to almost to the street that I've been watching for years. I'd like to jump in and take advantage of that. So that's fine. But do that transaction. Go ahead and make that purchase. But for people who don't feel an absolute need to purchase a home today in provinces like Ontario and British Columbia, maybe even Alberta, Quebec, prices in all likelihood are going to be less in 6 months than they are today. So why not purchase at a lower rate? Because guess what? Interest rates will fluctuate, but the price you paid when you made that transaction happen, that's the price you're going to have forever. Interest rates will fluctuate. The price you paid is eternal.
And finally, just to close off this session, what is your long-term view of the market?
Well, my long-term view of Canadian real estate is generally positive. If we can just get through this difficult, exacerbating problem of prices versus incomes. If we can just somehow get to a point where we're not 7, 8, 9 times family income to purchase a home, the long-term effect on Canadian real estate of our immigration policy, again, I got to stress this long-term, immigration is not going to change the world next year or the year afterwards, but we are lucky in that we bring a lot of new Canadians into this country. We're lucky for a lot of different reasons. Some of these new Canadians are the true future of our country. I mean, they are people who've come here to work, to raise families, to contribute. And that's a wonderful thing. This country is based on immigration. This country, my grandparents came from somewhere else. A lot of people's parents came from somewhere else, and they've made big contributions. They've done a lot for our society, and it is one of the great things about Canada that we have become a country that has adapted to all these cultures and all these people who've come here and adapted in a welcoming way. And we've proven to the world that you can have this kind of society where people are welcome and people can join the mosaic of a country. So I'm a pro-immigration person. That said, it puts an eventual floor under all prices everywhere. Again, regional. Not everybody moves to exactly the same neighborhood, so it doesn't put a floor under every price everywhere. But eventually, you have to think that Canadian real estate is a decent long play. But that doesn't mean you can't have a number of years of bad results. And that's something people should be aware of. Bad results for a few years, immigration is not going to save everything in the next 6 months. But long term, this is the growth of this country by bringing in productive citizenry is just a positive. It's not a negative. If you look at the United States right now, they've gone through 4 years of some of the lowest legal immigration that they've ever experienced. And they're actually starting to feel it within their labor force, that they're missing people that they need to do jobs. It's selective, it's not uniform, but hey, we don't want to end up like Japan, where there are more or less guaranteed destructive demographics, where there's whole villages and towns that are hollowed out in Japan. I'm not sure we want that for Canada. Growth and bringing in new dynamic people. Hey, here's what I've always believed: that people who come here are the kind of people who take a chance, are the kind of people who are willing to make that big break from their existing home. They've got some guts. They've got some spirit that tells them that I want to do something better for the next generation. And that's a wonderful, wonderful thing. It's the kind of people we want. We probably don't want to import any more permanent landlords. I mean, you should probably give that some thought. That's a subject for another day. But for people who want to come here, work, raise a family, contribute, pay taxes, yeah, it's a great thing. And it does eventually put a floor under Canadian real estate.
Well, thank you so much for your time, Ron.
Thanks very much, Will. Appreciate it.
Thank you.